Sir,
Guys, we'll start by 9:05 or something once everyone joins in.
Sir, I have a doubt.
Yeah, yeah.
Sir, in case of a sale, the last year we won't calculate depreciation, right?
Last, you won't calculate depreciation. Yes.
Sir, can you explain the reason? Yesterday I was able to understand it, but I didn't able to note it down.
See, technically, I'll tell you, you are calculating the depreciation. Okay. Now, there are two ways. We are just looking at presentational changes. Okay. Like, let me show it to you. Let me open the question. Can you see the screen?
Yes, sir.
Okay. Your net profit or loss on sale of asset is 32 million.
Yeah.
Okay. If you charge depreciation for 5 years, your WDV comes down.
Yes, sir.
Fifth year, you put in the depreciation. It is still 32 million
Yes.
because 1.2, 12 million will go in depreciation, 20 million will go in balancing allowance or charge. So it's not that we are not charging it, but rather than showing it as a depreciation, we present it as a difference between the buying and selling of asset. Because opening balance of WDV is of year 4, right?
Yes.
Understood?
Okay, sir.
Technically, you're charging depreciation, but what happens is in the fourth year, the opening balance of fourth year, less the selling is something that goes over here.
Okay.
Okay?
So it has a nil effect if we take the
Correct,
balancing allowance
correct,
portion.
correct, correct,
Sir,
correct.
but can we do it
Sorry?
because we have to disclose everything, right?
No.
Because oh,
You
okay.
can see, you want to see, understand, you're not making financial statements, you're doing financial modeling.
Okay, sir.
What you're looking from is the stat audit standpoint, where you put in everything and all of those things. Okay, as per the stat.
Yeah. Yes.
Over here, we are doing financial modeling. These are
Okay.
financial models for business and investment analysis. This is the bare minimum basic that we do logically. See, over here, there is no rule-based thing. Over here, it is a logic-based thing that, okay, fine, depreciation, even if I charge or don't charge, it's one and the same thing, right? My net tax
Okay.
liability will be based on this only profit or loss, whatever I make. Clear?
Yes, sir. Sir, and if the scrap value is greater than the WDV, will be added.
Yes, you will add it, you will increase your profits, and you will pay tax on that. Rather than
Okay,
showing a
sir.
negative 32, you'll show a positive 32.
Okay, sir. Thank you.
Okay, guys, let's start. Is everyone able to see me, hear me and see the screen?
Yes, sir.
Everyone able to hear me and see the screen? Okay. So yesterday we had a question that was there, which is on the ATC company. Everyone has went back home and revisited this question. Guys, anyone has any other doubts on this question? Yes, no.
No.
No, sir.
Okay.
No, sir.
So guys, how do you decide when you use an net present value model, NPV model, how do you decide whether you should go ahead with the investment or you should not go ahead with the investment? What is the decision rule for you?
There is a positive NPM from the project.
Correct. If it is positive, you go
We'll
ahead.
accept the
If it is
project.
not positive, you will not go ahead.
Good.
What does it depend on?
The cash flow and the discounting.
No, it depends on the risk appetite of the company as well. Correct? Because end of the day, uh, even if my project is profitable, but let's say the project is very risky. Correct? Like for example, stock market is on a bull trend. You know you're gonna make money, but it's a very risky money. Correct? If whatever the trend is, the trend can reverse anytime. Right? A single day is enough to reverse the trend. So it depends on the risk appetite as well. Not necessarily that all the profitable projects are taken up by the company. Right? Similarly, we have something called as IRR. Have you guys heard of this term before?
Yes,
Yes, sir.
What does IRR mean?
Internal
the
rate of
rate at which there is no profit or no loss.
The rate at which my NPV is equal to 0. Correct?
yes, sir.
The point at which my NPV is equal to 0 is known as an IRR. Clear? Any questions still here? Everyone?
No, sir.
Okay. If I have to tell you what IRR in simple term, basically what it does is now it calculates it tells your NPV in percentage terms. Okay. It basically tells you what is your NPV in percentage terms. What is the decision rule for making IRR? IRC. Tell me one thing. If you're borrowing a loan for 10%, you're investing in a business, what is the minimum profit percentage that you should be making? What is the minimum gross margin that you should be making?
10%.
What percentage should you be making?
7%.
Listen carefully. You're taking a loan from bank at 10%. You're investing in a business. What is the minimum returns that business should give you?
10%. At
10%
least
10%.
10%.
10. Why 10%?
to cover the
Because
cost of
we
the
took a
loan.
loan for 10%. It's
Correct.
a cost of capital.
Bare minimum, if I make 10%, then I'll be able to cover my interest cost. Correct. So your bare minimum margin is that. So similarly, that's what IRR does. You compare the returns to cost of capital. Right? Because the end of the day, you are over here to give your investors the wealth that they deserve. Right? Now, when you have to increase or decrease the wealth of any investor, particularly, you need to do this. Understood? So you compare it with cost of capital to see whether, see, sometimes what happen is you make returns, right? You say, okay, fine, I'm making 5%, 6% profit, that's fine. But what is it that you're paying your investors? What is it that you're paying to the guys from whom you have borrowed the money? And I'm not only talking about debt finance, even the equity finance guys I'm talking about over here. Clear?
Yes, sir.
Any questions? Okay. So IRR, you compare it with discount factor and then you decide whether the project is viable or not viable. Clear? Okay. How do you calculate an IRR? IRR is nothing but lower. L means lower discount rate. NPV at lower divided by NPV at lower minus NPV at higher into H minus L. Clear?
Yes, sir.
Any questions, guys? Okay. Now, to calculate an IRR, you need to have two discount factors. Okay. You need to have two discount factors. Okay. When I say two discount factor means, I need a lower discount factor and a higher discount factor. Okay. The first discount factor will always be available to you in the exam because you cannot calculate an IRR unless you calculate an NPV. Correct? Right?
Yes.
The first discount factor will always be made available to you. Okay. The second discount factor is an assumption. Okay. There is no logic for that, but technically what we do is, if our NPV is positive using the first discount factor, we assume the second one to be a higher than the current one. Like at 10%, if my NPV is positive, the second one I'll assume 25, 30 or 11, 12, 13, anything, but higher than 10%. But if at 10% my NPV is negative, I'll assume a lower discount factor, that is 5, 4, 3, 2, 8, 9. Okay. There's no logic on assumption. You can assume anything that you want. Okay. Now, bear in mind, from an exam standpoint of view, please make your assumption within the range of 1% to 20% only. Not because that it is the range that is defined, but if you see our present value and annuity table, our discount factors from an only from exam standpoint, guys, I'm talking, okay? The discount factors are calculated and mentioned up to 20% only. If you take more than 20%, you will not lose any marks, you'll get everything, but then you'll have to calculate the discount factor for each year manually. But from an AFM standpoint, we also need to be mindful that this is a professional level paper and it's a time constraint paper as well. So we need to do our time management effectively as well so that we can finish our paper. That's why from an exam standpoint, assume between 1 to 20%. Clear? Now, what are the advantages of IRR? What do you think are the advantages of, okay, what are the advantages of NPV we saw yesterday?
We use cash flows and not profit.
Use cash flows and not profit, then
We take into
Takes
account
time
the
value
time
of
value
money.
of
time value of money.
Value of money.
Then what else?
It considers whole life of the project.
Considers whole life of the project, right? Do you think all these three advantages are applicable to IRR also?
Yes, sir.
Yes, sir.
Right? It is applicable to IRR because the base for calculation of IRR itself is NPV. Correct? It is simple to interpret and helps manager make a rough estimate. Now, if you go and tell manager, "Arey, my NPV is 10, 20, 30, he may get a little confused because he may not have heard about the term NPV. But if you tell him that, okay, we'll make 10% returns, 12% returns, he'll be able to easily understand, right? Yes or no, guys?
Yes, sir.
Limitations of using IRR. Now, what are the disadvantages? First of all, do you know what do you mean by conventional and unconventional cash flow?
Sir.
Yeah.
Yes, sir.
Can you tell me what do you mean by unconventional cash flow, Sashi?
So the cash flows would be positive forever is a conventional cash flow. If the cash flows are positive, positive, negative, negative, it's an unconventional cash.
Unconventional cash flow means some year you are positive, some year you are negative.
Okay.
It's not always on an increasing trend. If something is positive every year, it is known as a conventional cash flow. Now, some year if you make a profit, some year make a loss, then IRR may not give you the right assumption. IRR assumes that whatever returns you make in the very first year, okay, in the first year, whatever returns you make, you reinvest it at IRR. But technically speaking, whatever money the company makes, see, every project makes a different amount of return. Okay. If you get the money in the first year, do you think your investment in the second year, the rate of return for the second year is also going to be the same?
No.
No, right. If you invest in different projects, definitely the rates are going to be different. If you're not investing, you're saving, then bank FD would be your rate of interest. Correct. So technically speaking, you don't every year reinvest the amount into a different project, right? You finish the whole project, or till the time you'll keep the idle money sitting with you into a temporary funds and all, right? Like fixed deposits and all, so that till the end of completion of the project, you are there. Clear? Any questions till here? Now, IRR cannot be used to assess mutually exclusive product. You know what do you mean by mutually exclusive?
So
Can you give me along with an example?
mutually exclusive project is that one project is not dependent on the two projects are not dependent on each other and they are totally different projects.
That means if you're investing in Flipkart, you cannot invest in Amazon. Correct? Simple as that.
Yes.
Right? Because it's a conflict of interest, right? Both the projects cannot go. If you're an investor in Flipkart, you cannot be investing in Amazon, right? That's what a
Yes.
mutually exclusive project would typically mean over here. And if you're doing two mutually exclusive projects, obviously the comparison and the rate of comparisons and everything may not be the same, right? So you need to deal with them accordingly. Now, if the cash flows are not sufficient to cover the initial investment, that means if your NPV is not zero or less than zero, then you cannot calculate an IRR, right? Because then there is no return technically, correct? Because IRR is internal rate of return, but if you're not having any returns or let's say zero returns also, but your returns are negative, then there's no way you can calculate an IRR. Correct. You don't want to, someone doesn't want to know what's my negative return. Correct?
Yes, sir.
Sir,
Yeah.
so non-conventional cash flows means irregular cash flow.
Yes. Irregular cash flows. Year one, you make a profit. Year two, you make a loss. Year three, you make a loss. Year four, again, you make a profit. Like,
Okay.
let's say it may be majorly applicable, let's say for seasonal businesses. When there is season like umbrella and all, 8 months low sales could be a reason you could be in loss. But 4 months when the rainy season is there, they cover up for the whole year. Understood?
Yes. Sir, and if NPV is even nil, we cannot, the last point is IRR is not applicable.
Yes.
Okay.
Let me show you with an example over here only. You remember yesterday we did this question? Yes or no?
Yes, sir.
Okay. I will take same question as an example for you. We calculated at 12%, right? Okay, just give me a sec. I'll just plug in my charger. Okay. Now, our NPV at first discount for a factor was positive or negative?
Negative.
Sorry,
Negative.
negative. So what is the second discount factor I can assume?
Higher than previous.
No.
Lower
Lower,
rate.
lower than previous.
Lower the discount factor, higher goes your returns, right?
Yes, sir.
Because the discount factor is nothing but cost of capital. If the cost of capital comes down, automatically the returns will go up, right? So second
Yes.
one, I'm assuming 5%. So at 5%, these are my discount factor, that is 0.952, 0.907, 0.862, 0.823, and 0.784. Clear?
Yes.
Present value, I calculate the present value based on my cash flows and all. I calculate my NPV. So I have two NPVs now. These two are my NPVs. The one in orange that I've highlighted,
Yes, sir.
correct? Now understand this thing. Which one is NPV at lower and which one is NPV at higher?
NPV at
NP at 5%
PV
is
at
higher.
5% is
Which one?
Higher. NPV at 5% is higher.
Okay.
it is lower.
Now I'll tell you. In IRR formula, NPV at lower and NPV at higher, NPVL means what is the NPV at a lower discount factor and what is the NPV at a higher discount factor. Understood? NPV at higher and lower does not mean which NPV is higher. It means at lower discount factor, what was your NPV? At higher discount factor, what was your NPV? Clear, everyone?
Yes, sir.
So my formula
Yes,
is
sir.
lower. Lower is nothing but 5%. Lower discount factor is 5%
Yes, sir.
plus NPV at lower I have taken, that is 28 divided by NPV at lower minus NPV at higher. I have closed the brackets. Then I have done high minus low. Clear? And my rate of return has come as 10.31%. Do you think we should take the project or not take the project?
Not take the project
Why?
because its existing discounting factor is 12%.
Because its existing discount factor is how much?
12%.
12%.
12%. The original discount factor is 12%. Clear?
Yes, sir. Sir,
Yes.
so I told if NPV is negative, we cannot able to calculate IRR.
I said if you look at over here, if the cash flows are not sufficient to cover the initial investment, IRR is not possible. That means IRR is irrelevant for you. This is just an example that we are taking to understand how to calculate an IRR.
Okay.
Okay. Because if in both the cases this happens, see, it's not that you cannot calculate, it will give you negative returns, right? If both the NPV are negative, you'll end up having a negative return in both the cases. Understood?
Yes, sir.
See, it is a mathematical calculation, right? Logically, it's not that you cannot do it. All of these are financial models and assumptions, right? You can calculate it, but that calculation is irrelevant. You will not use it for any of your decision-making techniques. Clear?
Yes, sir.
Yes.
Now, since you are doing IRR and all, obviously you'll have to comment on IRR as well. Yes or no? Any financial model, you are expected to give a decision as well, right?
Yes, sir.
So how will you write your decision in this case?
So here IRR is 10.31%, which is lower than original discounting factor 12%. So based on that, the decision would not be going for this project.
Correct. So guys, these are the two common statements that you can write. You don't even need to calculate and you can still get your 1 mark. If the IRR is greater than cost of capital, the management should go ahead with the project. If it is lower, the management should not go ahead with the project. However, depends on the risk appetite. Clear?
Yes, sir.
Okay. I'll give you 2 minutes. Can you just go through this IRR solution and let me know if you have any doubts? And guys, I want you to solve it by yourself because many people will go wrong in calculating IRR in Excel. I'm not talking about in calculator. So just try it by yourself and let me know if you have any questions. I'll wait for 2 minutes to you to go through this. Let me know once everyone is done as well.
Sir, done.
Everyone done, guys?
Yes, sir.
Anyone who's not getting the answer? Everyone has got this answer. Can you solve illustration 6 by yourself and tell me what is the percentage you are getting?
So can you scroll down?
It is the question over here. I will not scroll right now because there's a solution I don't want you guys to see. This is just a one-liner question.
Sir, 18.3%.
Okay. Anyone else who got the answer?
Yes, sir.
Everyone is getting 18.3%.
Yes, sir.
Everyone has got this, right? 18.3%, guys. Anyone has any different answer altogether or anything as such? Yes, no. Everyone understood how to calculate?
Yes,
Okay.
sir.
Yes.
Since IRR has a lot of demerits and all that cannot compare unconventional cash flows, cannot compare other bits and all. Some of the demerits can be overcome. Okay. Some of the demerits can be overcome based on MIRR. MIRR is nothing but modified internal rate of return. Okay. Modified internal rate of return is a little advanced than internal rate of return. And based on that, we will be doing our calculations, and these modified internal rate of return typically is little advanced and covers not all the demerits, but some of the demerits. Clear? How do you calculate an MIRR? PVR means present value of return phase divided by present value of investment phase raised to 1 by n. 1 by n is nothing but number of years into 1 plus RE. RE is nothing but, guys, discount factor, cost of capital, or whatever you want to call it as. Clear? What will be a decision-making rule in this case?
If
High
MIRR
rate,
Sorry?
modified IRR is greater than cost of capital, then the project is financially viable.
Correct. Now, what are the advantages of MIRR? First of all, MIRR shares all the advantages of IRR. Okay, this is a typo error. It is meant to be IRR. MIRR overcomes an unrealistic assumption that all your money that you have, all the money or yearly returns that you make are reinvested at IRR. Okay, but it is actually reinvested at what is it? MIRR makes a more accurate assumption that money is being reinvested at MIRR.
MIRR.
Okay. But technically, whenever you're doing any kind of reinvestment assumption, it should always be at the risk-free rate of return. That is your bank FD, corporate bonds and all. Correct. It's a project-based thing, right? What are the disadvantages? It is actually a little
More
complicated. It is, see, when there is simple projects and all, it's fine. But when there are complicated projects, then it becomes difficult to identify what is the returns phase, what is the investment phase. Correct? The assumption at that cost is that the money is reinvested at cost of capital. Okay. IRR, reinvestment assumption at IRR. MIRR, reinvestment assumption at cost of capital. Okay. Okay. But still, you will not reinvest your money at cost of capital, right? The bank FDs are the ideal rate for that. Clear?
yeah.
Any questions?
No, sir.
Okay. Can you read illustration number 7? Can you read illustration 7? So a project has the following cash flows: year 0, negative, then 1, 2, 3, 4. Cost of capital is 8%. Okay. To calculate MIRR, what all information do I need?
Present value of
Returns
return
phase,
phase, investment phase, cost
investment.
of capital,
Okay. We
number
have
of
cost
years.
of capital.
Yes, sir.
We are given free cash flows. That means we need to calculate present value. Correct?
Yes, sir.
Present value discount factor table. Let me open it. Okay. What's the discount rate?
8%.
So this particular column.
Yes, sir.
Now, so 9259, 875, 793. We calculate the
733.
present value. Okay, we multiply the cash flow with the present value and we do it. Now, which is my investment phase and which is my returns phase?
40,000 is our investment phase.
Okay.
The cash inflow, cash flows are our return phase.
Correct. So 1, 2, 3, 4. Yeah, the total of year 1 to year 4 is your
Return phase.
return phase. Clear? Clear, everyone?
Yes, sir.
Okay. Can you put it in a formula and try to calculate by yourself? Everyone knows the formula, right?
Yes, sir.
I will pull it up on the screen as well. This is the formula. Can you try and solve it by yourself?
Sir,
Yep.
so if there is negative cash flow, that is cash outflow, we should consider it as a investment phase.
Right. No, not negative cash flow. If you are having an investment in that period, negative cash flows can be due to operational losses also.
Okay.
Okay. If you're doing investment, then it's an investment phase. But if you're having negative cash flow due to operational activities, it becomes still your returns phase, no?
Okay.
Can you please calculate what is the MIRR you are getting?
So 11.03%.
That's fine. You can round it off. You can keep it to 2 decimals. You can round it down. Anything you want to do is absolutely fine. Everyone has got 11%. Anyone who's struggling to solve this on Excel? Guys, anyone who's struggling to solve this on Excel?
No, sir.
Can you see sir, the line that I've highlighted right now? Okay. This equal to till here is exactly what you need to do. Clear? This is
Yes,
how
sir.
you should be typing it in your Excel as well. You can automatically get your answer. Clear, everyone? Yes, no, confused.
Yes, sir.
Okay. This is illustration number 8. Okay. It is asking us to calculate NPV, IRR, MIRR. Okay. This is also past exam paper. Considering the cost of capital is 13%, I'll give you 10 minutes. Can you try and solve it by yourself? I'll ask any one of you to present. Since we have done it, you need to calculate NPV. The cash flows are directly given. You need to find out present value. Cost of capital is given. You need to assume IRR and MIRR. For IRR, guys, the second discount factor in class, I want you to assume to be 20%. Okay, I want everyone to assume this. The first discount factor is 13%. The second discount factor, I want you to assume at a 20%. Okay, you can assume 15 also, no wrong. But then when we are discussing the class, people may have a disconnect when they use different, right? So just to be consistent in class, I want you to use that. And guys, this is also a past exam paper, an extract from a past exam paper, which is there. I'll give you 10 minutes. Your time starts now.
So we have to take 15%, right?
20%.
Okay.
First one is 13%. Second is 20%. You need to calculate present values. You need to calculate everything.
Sir, can you please cancel the notification?
Yeah, just a second.
Because half of the. Thank you.
First thing, put up the pro forma and then do on to the stuff. Guys, your time is almost done. You have couple of minutes more. You guys are able to get through, right? Anyone who got the answer for the IRR?
Yes, sir.
How much?
25.64 for Omega.
Okay.
21% I got.
Okay. No problem. Let's finish the question. We'll discuss the answer together then to see where you guys went wrong. So your MIRR calculation is still pending, right?
Yes, sir.
Okay.
Sir, I got it for MIR Omega,
Okay.
22.74%.
Okay. And what about Zeta?
So I have to calculate.
Please go ahead.
So for Zeta, NPV is 1600.
Okay.
IRR is 25.64 and MIRR is 23.37.
Okay. Guys, everyone else is also done solving or you guys are still doing? Naomi.
Still doing.
Okay. I'll wait for 2 more minutes, guys. Please do it by yourself. Because I want you guys to do it and then we discuss the answer so you know where you go wrong. Otherwise, if we keep on doing, everything will come answered as right. Let's wait for a couple of minutes. I'll give you 2 more minutes. Guys, done everyone?
Yes, sir.
Yes, sir.
Okay. Did everyone get NPV at 13% at 1490 for process Omega?
Yes,
Yes,
sir.
sir.
Anyone who has got a different
Yes.
answer?
144
One?
1.10.
Okay. Can you check your yearly number, Naomi? That is year 0, 1, 2, 3, 4, 5. In which year are you seeing a mismatch?
In the first year.
In the first year. Why
Hmm.
are you seeing a mismatch? Have you taken the discount factor as 885?
No, I took 855.
Why
Um,
why did we take 855? What is the discount factor? 13%.
Sir, it's my mistake, sorry.
Because see guys, your last digit of the NPV, if it does not match, I'm fine. And guys, keep in mind in ACCA, it's not on the totaling that you want to get tested. But technically speaking, your first 3 digits of the NPV should tie to your answer because it's that big a number in materiality.
Sir, even
Okay.
the third year is different.
Sorry,
Third year,
what is the discount factor? Check your discount factor.
0.693.
What have you taken?
0.693.
And this 1386?
Yeah,
And what is the number you're getting?
948.02.
Is
Sir,
everyone getting
it
the
could
same
be
difference?
rounding, sir.
No, 948, 960 is a difference number, no?
Right.
In Excel, you cannot have, you get 960. Check your formula. Have you taken 0.693 or have you taken 0.39639?
0.693.
No, not possible. Can you present your screen?
So it's my formula mistake.
Because yes, technically, 959, 961, I would have still agreed it's a round off. But 948 is a different number altogether. Yes, someone else also had any question?
Yes, sir. So your two का different आ रहा है sir.
तो check करो
It's
discount factor check करो और calculation check करो. Answer exactly tie होना चाहिए.
so it's not getting matches. Actually, it's coming to 1215.
Can you present your screen?
Yeah. Wait.
Present it.
Are you able to see, sir?
Sagar, what is the cash flow that you have taken? Have you taken it correctly?
1553.
No, it is 1153.
Okay. Sorry, sir.
Yeah. So guys, see, understand, it's pretty simple, right? We are doing a calculation. There are only two factors that are affecting the calculation. One is the cash flow and one is the discount factor. If your answer is not tying back, that means either one of the numbers you have not done it correctly. It cannot be possible in Excel that you are solving it in Excel and you get a different answer for the same variables. Clear?
Yes,
Any
sir.
questions, guys? Anyone has any other questions? Okay.
No, sir.
At second discount factor, are you getting NPV at 20% at 664?
Yes, sir.
Yes, sir.
Everyone?
Yes.
Okay.
I'm getting 666.
That is fine. That I can still accept that is a round off because that's the last decimal you're talking about. Your second decimal cannot be going wrong. First, second, and all. And when you're dealing in 4 digits, your first, second, and third decimal cannot go wrong. Clear?
Yeah.
Right? Because see, technically speaking, if I round off this 664.5, I will present it as 665. Clear?
Yes, sir.
Okay. even IRR, guys, if if this answer is 25.63, even if you get 25 or you get 26 as an answer, I'm fine with it. You're not losing any marks for that. Round off has no mark reduction or increment that is affecting. Your formula and your plotting of numbers should be correct. Clear?
Mm.
Any questions? Okay. So for the second part, did everyone get IRR as 27.92? For process zeta, everyone got that? Sorry, my bad. This is for which process? This is for process omega, and then they're trying to calculate the IRR with a different discount factor. So guys, over here they have calculated with additional, they have made one more assumption for 30% as well. But you don't need to do it in the exam. You're expected to calculate only one IRR. This is just for an illustration purpose. Everyone is clear till 25.63?
Yes, sir.
Anyone, any other questions? Okay. Let's come to MIRR. MIRR, what is my returns phase? Which year is my returns phase?
1, 2, 3, 4.
1, 2, 3, 4. So what is the present value of my return phases?
5290,
5290.1.
5290. My investment phase?
3800.
3800. So, and how many numbers is the project for?
4 years.
4 years.
4 years. So that means, what is my MIRR?
22.74%.
24 point?
22.74.
22.74.
74.
Okay. Now you need to compare this Omega project with Zeta project. Zeta project is already given to you. Omega project you have calculated. Over here, we are not trying to see which project should I take or no. We are trying to see should we go with project A or project B. Correct?
Yes, sir.
Because our NPV is positive in all the cases, so definitely we are going ahead with the project. That's a different case altogether. So, clear everyone? Anyone has any questions on how to calculate an IRR, MIRR and all? Yes, no? Are you guys able to comfortably solve it by yourself now? This was a past exam question, guys, by the way, because IRR and MIRR is not complicated. The complexity will arise when you'll have to calculate an NPV. All your adjustments will be in NPV. Once you solve NPV, IRR and MIRR is a formula-based thing. You cannot do anything in formula. Clear?
Sir,
Yeah.
which project are we,
Sorry.
which project are we undertaking?
We are just giving the analysis, which project is going. So you just have
So
to
we
say, okay, if you go by NPV, see, NPV will tell you to go with different project. IRR will tell you to go with a different project, and MIRR will tell you to go with a different project. Like if you go by IRR, you should go with Omega. But if you go by MIRR, you should go with Zeta. Correct?
Yes, sir.
Question is not asking us to do that. Question is just asking us to do an analysis on that. Calculate and recommend which process, if any, TISA should proceed with an explanation of your recommendation. So what you have to do is, you'll have to write, if you take NPV as a base, which project you will go with, and you'll have to write its advantages and disadvantages. Correct? Because you are along with recommendation, you also need to tell why you are recommending it. Correct?
Yes, sir.
Clear, everyone? Then the second part is, if you go by IRR or MIRR, why you are going? Why answer is the advantages and disadvantages. Clear? Any questions, guys? Anyone has
No,
any other questions?
No, sir.
Okay. Let's move on to the next part. Have you guys heard of payback period?
Yes, sir.
What do you mean by payback period?
time
The
taken
period
to
in which initial investment will be recovered.
The period in which
Initial investment will
Initial
be
investment will
recovered.
be recovered.
initial investment will be recovered. Correct? So everyone knows payback period. Is there anyone who doesn't know? How do you make a decision in payback period?
lower is better.
But lower than what?
Time period.
No. Lower than what? You are calculating the payback period for your project. How do you know this is a right payback period, a lower payback period, or a higher payback period?
Compare with another project.
Compare with
Another project.
Another.
another
Us
project,
are the same project.
right?
Similar project.
We call it as a similar project. You might not find the same, but you might like when Jio wanted to start a business, they would have taken Airtel as a base for a comparison, correct? Because
Yes.
the payback period is for the company. And we don't know if I calculate a payback period 2 years. I don't know whether 2 years payback period is good or bad, right? I will say, alright, 2 years. For me, it may be good, but if someone is recovering it in 1.5 years, that means I need to optimize my processes.
Yes, sir.
Correct? Yes or no, guys?
Yes, sir.
So in case of payback period, you need a comparison.
Same.
The shorter the payback period, the better it is. Okay? First thing. Second, have you guys heard of discounted payback?
Yes, sir.
What do you mean by discounted payback?
The cash
Time
flows.
value of money.
Correct. You don't take on free cash flows, but you discount it. See, technically, if you ask me, I would rely more on discounted payback, right? Because I am getting my initial investment of 500 or 600 after 2 years. The opportunity aspect in that is not considered, right? So going with the payback, so discounted payback is nothing but taking into account the present values and then looking when will I recover. Do you guys know how do you calculate a payback period? Have you heard of cumulation method?
No, sir.
No?
No, sir.
I'll tell you, I'll come to that. Can you read this illustration 9? And I want you guys to calculate the present value. I want you guys to calculate the present value for illustration 9. After that, we will see how to calculate a payback period. I'll give you 2 minutes. It will not take more than 2 minutes in this case. And do the calculation below one below the other. That is year 0, below that year 1, year 2, year 3. I don't want you to do it in rows there. Everyone done calculating?
No, sir.
Okay.
Sir, NPV is 107, negative
We don't need
107.
NPV in this case. Because we are just trying to see. The issue with the payback period is, guys, we are just trying to see when will I get my investment back. You know, sometimes when you guys do investment and all, you say, okay, fine. If I get my principal back, whatever I get after that year is a bonus for me. I don't care even if the money gets to zero when I recover my principal back, right? And the primary objective of any investor is also to ensure that how fast he recovers his initial investment. Because the moment he recovers his initial investment, he's secured. Correct? Okay. So guys, can you see the table in front of me?
Yes, sir.
Okay. So you have one, you have discount factor, you have present values. I don't think I need to explain it to you. What do you mean by discount factor, right? Now, in the first year, you're having what? Negative 1700? Yes or no?
Sir, how does it turn to
Yes, sir.
But in
1700?
question, it is given 2100,
2100.
right?
Okay, I think this is a typo error, guys. Please consider this as 2100 or 7100, whatever you guys want to go with. Let's assume this to be 1700. Okay. You can make a manual correction in your notes in the question, please. This is 1700. Okay.
Yes, sir.
So in the first year, you are having a negative 1700. Next year, how much are you making?
364 inflow.
So your investment, out of your investment of 1700, how much have you recovered?
364.
364. So what is the balance left?
1 double 2 3 6.4
6. Then after that in the year, how much did you recover?
413
What is the balance you're left with?
923
Then 751. So you're left with a balance of 172. Okay. Now understand this thing. Next year, now you need just 172 to recover your initial investment. Is that correct?
Hmm.
Yes or no?
Yes, sir.
But next year, how much are you making?
341
342.
169.
So 172 divided by 342 is how much?
0.5.
0.5. First thing, how many years did you take?
3
3 years.
First, second, third. And in the fourth year, you took half a year, right? That is 0.5. Correct?
Yes, sir.
Everyone with me till here? Naomi, Sashi, are you guys clear?
Yes, sir. Yes.
Naomi, are you clear till here?
Yes, sir.
Okay. So that's nothing but discounted payback period is 3.5 years. Clear?
Yes, sir.
Now, the problem with the discount factor is the payback period, guys. Whatever returns you make after your initial investment recovery, you don't factor that in your calculation, right? So just because, see, I'll tell you, whenever you invest in a project, I understand that you get your principal back. But if your project is not overall financially feasible, but you still manage to have a zero NPV, understand? Money wise, you are safe, but your efforts have gone, right? Now you would technically expect a return for your effort as well and for your time and everything that you are giving it to them. Correct? Yes or no?
Hmm.
Yes, sir.
Right. So in that case, what will happen is, just give me a sec. Okay. Everyone clear till here?
Yes, sir.
Now, the second one is the Macaulay duration. Why we take Macaulay duration is Macaulay duration is an advanced version of payback period. Okay, it not only considers the whole life of the project, but it also considers the different cycles and different aspect of it. Okay, uh, it considers the returns that you get after getting your initial investment back also, which is a demerit for the payback period, right? The moment you record initial investment back, if you see, there's no further calculation we do. We ignore the fifth year's 124. Did we or did we not?
Yes, sir.
Right?
No.
That's not a right way, right? That's not a right approach to that, right? Because for an investor, just not getting the initial investment back is one, though it's one of the key KPIs and parameters, but you also need to ensure that you get it other numbers, okay? So Macaulay duration is nothing but an advanced version of payback period, okay? And at AFM level, Macaulay duration is more likely to be tested than a payback period because the payback period already gets tested when you do FM. Okay. So Macaulay duration is which is an additional topic which is there in AFM. Clear? Now, what are the steps to compute Macaulay duration? First of all, you will discount all the present values of only the returns phase. Okay. Then you will multiply the present value by the year. That means if it's the first year and your present value is 100, you will multiply it with 1. In the second year, if your present value is 200, then you'll do 200 multiplied by 2. Third year is 300, then 300 multiplied by 3. That is present value into year. Simple.
Okay.
And then you take a total of that and divide it by your NPV. Clear?
Okay, sir.
Again, how will your decision, what will be your basis of decision in Macaulay duration? Macaulay duration basically tells you an average time taken to recover your investment. Correct? Rather than telling when will you recover. Right? So how will you decide whether you want to go with it or not go with it? What would you need?
Comparing two projects, same as payback period, what we have done.
Comparing it to the project same as?
What we have done in payback period.
Okay. We will need a targeted Macaulay duration. Correct?
Yes, sir.
Can you read illustration number 10? And can you calculate the present value, please?
Yes, sir. Present value.
Everyone done?
Yes, sir.
Can you guys see my screen?
Yes, sir.
So did you guys get the present value as 20188 NPV?
Yes, sir.
Everyone got present value as 2088. Okay. To calculate the Macaulay duration, what all information do I need?
Summation of present value into year divided by summation.
Summation of present value into year
Yes.
divided by the summation of present value.
Yes.
Summation of present value is nothing but NPV.
Yes, sir.
That is this row. Correct? Now, present value into year, you only take it for returns phase. Correct? So you take present value, first year will be multiplied by 1, second year multiplied by 2, third year multiplied by 3. Correct?
Yes, sir.
And you have a total of 36,
108.
108. Clear? Any questions? Can you calculate the Macaulay duration for me and tell me how many number of years, what is the average number of years comes to?
So 1.8 years.
1.8 years. Everyone got this?
Yes.
Yes, sir.
That is nothing but your both of them divided by this thing. Clear?
Yes, sir.
Now, these are the so apart from NPV, these are the other factors and parameters when you do actually go in the real life and all. Along with your returns on the project, you also comment on what is the returns expected, how is it expected, how much of it is expected and all. Clear? Any questions still here, guys? Anyone has
sir.
any doubts? No? Okay. The next one is foreign NPV and investment appraisal. Okay. Let's take a quick 20 minutes break and be back, and then we will start fresh. Now, guys, till now, apart from MIRR and payback period, sorry, the Macaulay duration, whatever we have studied, you could relate it's a quick recap of the basics, correct?
Yes, sir.
You must have studied it somewhere.
Yes,
You must
sir.
have studied FM, SFM, or any of your college or degrees and all. Okay, basic parts. Now what we'll be going is to the real AFM where we'll be dealing with foreign NPV and all of those stuff. Clear?
Yes.
Okay.
Okay.
So it is
Yes, sir.
10:25. Let's take a quick 25 minutes break and be back, and then we will go on to the foreign NPV. Okay, guys, let's start. Is everyone back?
Yes, sir.
Okay. So, guys, what about others? I can just hear one person saying he's back. For Aaron, Bharat,
Yes, sir.
Niyati, Navjot, Yukta, are you guys back?
Yes, sir.
Yes, sir.
Now, guys, let's talk about the foreign NPV. Okay. All the investment appraisal techniques and everything that we have seen till now. Okay. All you must have seen that uh, everything that we are doing is assuming that we are in the local country. Correct? But uh, does that mean that when you work for a company and all, you will always have something or the other going on in local country only? Or you will have it in foreign country as well? You might have an opportunity in foreign country as well, correct?
Yes, sir.
Right? You might have an opportunity in foreign country as well, and you need to ensure that in those foreign countries also you perform. So, but do you think we can use our normal NPV calculation for a foreign country as well? Can we or
Yes.
can we not?
You can use.
We
No.
can use. Okay. But I'll have to tweak it to some adjustments, right? Because foreign exchange rates changes every year. They don't remain constant. There are a lot of government regulations when you remit the funds, correct?
Yes, sir.
When you take the funds from inside or when you take the funds from outside and all, there are a lot of restrictions on those things as well, correct? So that's one of the aspects that you need to take care of. Clear? So,
Yes, sir.
so we will learn in foreign NPV how do we do things. Okay. So these are the steps. Okay. Foreign NPV mein there are only 3 adjustments that are different from our normal NPV. Okay. The first step is calculate your NPV as normal. That means if you're in India, you're investing in US, calculate what is the dollar value NPV. That means what is the NPV, what is the free cash flows in foreign country. Okay. Then what will you do with those free cash flow? Once you make profit in US, what do you do with that money?
Convert into
We need to bring that money to the country where the
local
company
currency.
belongs, right? Home country.
Home country.
We will convert and bring it to
Home
home
currency.
country. Okay.
Yes, sir.
Conversion rates might be given or might not be given to us in the exam. We will see how to calculate it. Okay. Then now understand one thing. There is one small tax adjustment over here. Okay. There is something called as top-up tax. Okay. What does a top-up tax means? Top-up tax means, see, once you are making profit in US, you are paying tax over there. Correct? And then bringing that money to India.
Yes, sir.
Okay. Do you think you will again have to pay 30% tax in India?
No.
No.
No. Between all the countries, it is understood because see, if both the countries has to pay tax 30-30, then effectively 60% of the money is gone to the government, right? So all the countries have a treaty which is assumed. Okay. So if you are paying 30% tax in India or US, and India tax rate is 30 or 35, 25 or 30%, you do not pay any tax in India. But if your tax rate in US is 30 and India it is 35, that means you have paid less tax as per Indian government. They will ask you to pay a differential of 5%. Understood?
Yes.
So if the home country's tax rate is higher than foreign country, the differential needs to be paid. Now let's say if it is otherwise, if the home country is less than the foreign country, do you think you'll get a refund?
No.
Why?
So it's not.
यार
Because
आप
they did
Because
not
it's
pay the tax.
obviously right, बिडेन को पैसा दे के आए हो, मोदी से रिटर्न मांग रहे हो, ऐसा नहीं चलेगा, right? Government has only one way. It is only incoming. There is no outgoing for them, income tax department, right? We
Yeah.
all know that. Clear on this tax adjustment part?
yes, sir.
Okay. Second thing, there are a lot of restrictions when you have to transfer the money to foreign country, or let's say to bring it back. Because if Infosys is in US, they want to remit the money back to India, the government may not allow, or they may put a restriction, correct? Why? Because Forex reserves are one of the key KPIs for government performance, right? Higher the Forex reserves, the more better the company is doing. Correct. So whenever the foreign exchange currency goes out of the country, okay, government has a lot of restrictions. So what these companies do is they pay royalty or a management fee. Okay. That means Infosys US will pay a management fee to Infosys India
India.
under the name of brand royalty or management fees. Correct? That's one way of bringing the money. Now understand, this is an expense. What they will say, okay, you're using my brand name Infosys and hence I'm charging you a royalty for that. My leadership team, CEO, CFO is managing the business from over here, so I'm taking a management fees from you. So that becomes an expense. That does not become remittance of profit, correct?
Mm.
Now, royalty and management fees will be an expense in US. When you
Yes, sir.
prepare the US working, it will be an expense.
Yes, sir.
But when you convert that money to India, what will it be in India?
Income.
It will be an income. Now, there's one tax element to this. Have you paid any tax on royalty and management fees in US?
No.
Why no?
No, sir.
Maybe withholding tax.
Because it's an expense.
Because it's an expense. Okay. Niyama, you're correct. There could be some withholding expenses, but withholding expenses out of purview because end of the day it gets calculated in total tax. Right? Okay. Now, but when you bring that money to India, Indian government will take 5% or they'll take full 35%.
Full 35%.
They will say, boss, this amount of money, you haven't paid any tax there. So on this royalty and management fees, give me 35%. On your balance operational amount, just give me 5%. Correct?
Yes, sir.
Government अपना पैसा नहीं छोड़ेगा. Go by that logic. Tax has to be the maximum that has to be paid. Clear, everyone?
Yes.
Yes, sir.
Yes, sir.
Okay. Now, how do you calculate the foreign exchange rates? There are two methods. One is known as purchase power parity theory and one is known interest rate parity theory. Okay. In that, what we do is we take the spot rate into 1 plus HC. Okay. HC is a simple way to remember is 1 plus foreign currency inflation or interest divided by 1 plus home currency interest or this. If you take interest factor to calculate the foreign exchange rates, it is known as interest rate parity theory. And if you take inflation as a way to calculate the foreign exchange rates, the future rates, then it becomes a interest rate parity theory. Sorry, purchase power parity theory. Clear,
Sir,
everyone?
can you repeat?
Yeah.
Sir, can you repeat once again?
In either of the method, you just need to do 1 plus foreign divided by 1 plus home. Okay. Now, sometimes interest may be given and sometimes inflation may be given. If you use interest to calculate the foreign exchange conversion rates, it is known as interest rate parity theory. If you use inflation as a measure to calculate your parameters, it is known as purchase power parity theory. Clear?
Yes, sir.
Okay. Top up tax, I have already explained it to you. Tax effects, I have already explained it to you. Now let's do one thing. Let's solve this question and understand how we can do this. Okay. I'll tell you which example to be done. Okay. We will understand this with the proper full exam standard for an NPV question. I will walk you through step by step. Understand there is no rocket science in this. We will just be doing our fill in the blanks. Everyone has access to question number 13, Yelandway question. Yes, no.
Yes.
Yes, sir.
Okay. Evaluate the financial and the acceptability. That means nothing but calculating the NPV. Okay. Can you read this question, please? I'll give you 10 minutes to read this. Read it very carefully. Then we will solve it together to see how a foreign NPV works. Okay. Let me know if you guys want me to scroll down. I will do it.
Yes, sir. Please scroll down.
Should I further scroll down?
Yes, sir.
Guys, please let me know, okay, once you're done reading. This is fine?
No, sir. No, sir. It can be assumed that, yeah. Little bit
can
down.
be done. Yeah, okay.
So scroll down.
Guys, everyone else is also reading, right? Aaron, Afan, Naomi, Niyati.
Yes, sir.
Okay.
So that
Guys, what's the status with everyone else?
So done.
Done, sir.
Have you read this additional information?
Yes.
Okay. So since you have done reading the question, can you tell me what is the scenario in the question?
Sir, LNB is a company.
Just
Their
one sec,
current.
Sasi. So before you elaborate, keep in mind first, I want to know what does the company currently do?
Okay.
What is their forte?
Okay.
What new investment opportunity they are exploring? Where
Okay.
they are exploring? When they are trying to explore? And what do the management expect from us? These things are needed to be understood before we go into the challenge. So now start explaining. Yeah. Okay.
Sir, LNB is a company. Their currency is YR, LNB Rand.
Hmm.
Initially, they are facing economic challenges for past 25 years.
Okay.
Now, at the same time, they have a corporation tax is 40%. It leads to increase the inflation of 65%, but the current level of inflation is 33%.
Hmm.
So the stricter monetary and fiscal controls, uh, the perspective from other countries is good, but in local from LNB is bad. It's suggesting that from the scenario. At the same time, the LNB wants more investment in their home. So for that they conducted a international trade show. In the international trade show, they are announcing that zero corporation tax payable in the first 2 years of corporation operation. At the same time, an opportunity to carry forward tax loss and return off against future profits made made after the first 2 years. So, with the help of these announcement from the international trade fair, Imani company from US, they are planning to invest in LMD. So, Imani company is a manufacturer of high tech uh, diagnostic components for machinery, and at the same time they are exporting worldwide. So they are planning to invest in LNV for using those two opportunities for the announcement in international trade
Hmm.
fair. So here the home from hereafter we have to see from US perspective. So the US from the US the home currency is dollar and the LNB is the rand.
Hmm.
So uh,
So
US planning to uh, currently US has an assembly unit for the manufacturing of high tech component. Now they are planning to move the assembly plant to LNB to use the opportunity from LNB. So based on that, how much the cost involving, at the same time how they are going to increase their production capacity, these and all given in the second set of the scenario. So if you want, I can explain this, or else we can go ahead.
no, that's fine. That's perfectly. So basically, you know which is your home country?
LNV.
Ireland.
LNB,
Which is your foreign country?
US.
US. These two things are very critical to identify. Okay. Second, now, so basically, what they are starting a new project and they're exploring an opportunity in Naomi country, correct?
Imoni company
Imoni company.
starting
Okay.
see the opportunity in LNB.
Yeah. So now we first need to calculate our NPV, correct?
Yes, sir.
Okay. Mm. Everyone knows the, wait, let me just put up the pro forma first. And I want everyone to copy the pro forma first, and then we go on to the other bits.
So can you please zoom it?
Just a second, I'm just preparing the file.
Okay.
So,
Yeah.
sir, I think a mining company that is US is the home currency, home country, and we are investing in Finland way.
L&B.
I feel, I don't know.
And let's go to that. Let's try to understand. Okay. Uh, can you see my pro forma over here?
Yes.
Can you please copy this pro forma and put it in your Excel as well? Because I want to guys to solve simultaneously along with me. Put up this pro forma. This is a pro forma, a standard pro forma for a foreign NPV. Okay, guys? This includes all your aspect of your royalty management and other bits and pieces and everything that you need for a foreign NPV. Please copy this pro forma and let me know once you are done. Let me know once you are done. I'll scroll down so that you can do the working note also. See, guys, always have a habit of putting up the pro forma first. Because the moment you put up the pro forma, what typically happens is it becomes very easier for us. Because if in this question, you see, there is lot of information given to us, right? And we might not know which one is relevant to us or which one is irrelevant to us. Everyone done putting up this table?
Yes, sir.
Okay. Can you put up the tax and the sales revenue table as well?
So can you scroll slightly upwards? Just the last part of the
Till here?
royalty income flow.
Yeah.
Yes.
Okay. Please do it. Guys, please put up the tax table as well.
So done. Thank you.
You're done with the tax part as well. Put up the tax and sales revenue table. First, we will set up our complete pro forma. and then we will start filling the numbers in this to see how easy this goes. Guys, done with these two tables?
Yes, sir.
Okay. Do the variable cost, part cost, and royalty table. Guys, let me just speak up once you are done, right? So that we can start doing it.
Sir, can you go?
To the sales part.
Yes, sir.
Then let me know once you guys are done till the part of royalty.
Sir, done.
Everyone done?
Yes.
Okay. Can you do the working capital and the contribution part last, which is the last part? Guys, done everyone? Yes, no?
Yes, sir.
Okay.
Yes, sir.
Okay. Let's start. So, first of all, do you have the foreign exchange rates for all the years, or do we need to calculate it? Is it mentioned in the question, or are they expecting us to calculate? The very first
Yes.
thing in any of the foreign NPV question is you need to first ensure you have the conversion rates for all the years. Okay.
Okay.
Do we have the conversion rates?
Yes, sir.
Yes, sir.
Yes, we have the conversion rates. In this question, there are three parties involved. One Yelanwe Rand, $1, and £1. There are three currency if you read the question carefully, right?
Yes, sir.
Right?
Yes, sir.
Because see, when you manufacture something, you may import from London, you may import from US, then assemble in India. So there could be multi-currency involved. Okay. So any of the foreign currency, now, the very first thing that you always need to do and ensure is that you have all the conversion rates available. Because what happens is some costs are in dollars, some are in euros, some are in Yelanwe rands, and end may you'll struggle converting everything. Follow the steps and the protocols. Your answer will go on smooth. Okay. Now, which is the foreign currency and which is the home currency?
So US is the home currency and where is the foreign currency?
Right.
Yeah, Naomi.
Right.
Okay. Now, so Yeland. So first, we will try to calculate the free cash flows in.
Sir,
Yeah.
sir, can you explain once again the home country?
The question says, right, US is our home country, right? We are in US and we are investing in Yelandwe, right?
Oh, okay.
We
Yeah.
have to see from investors' perspective.
Yeah. We have to see from investment perspective, now, because it's a foreign NPV. The country where I invest is a foreign country for me, right?
Yes, sir.
Yes, sir.
Okay. Now, first thing. So that means I need to first calculate the free cash flows in Yelandwe company, correct?
Yes, sir.
How will you do it?
Start with sales revenue, deducting
Start
variable
with
cost. Sales
sales.
revenue.
So first I need to fill in my sales revenue. What is the question talking on sales revenue?
We are given units.
What is the question talking on sales revenue?
Sales
We have-
components per
We
year
have
only.
given we have been given number of units, right?
Yes, sir.
Yes or no?
Yes, sir.
And are we given the selling price?
Yes, sir.
Okay. What is the number of units?
150 for the year 1,
Then
480, 730,
then
360.
sales price is given to us
700 euros.
700 euros. Now I have a question for you. Is there any inflation mentioned in the question?
Yes, sir.
Yes.
How much is the inflation?
So based on EU,
Third year.
5%.
Based on
5%. European Union, sir.
how much percentage?
5% for 2 years.
Right?
Yes, sir. From third year onwards, it's 4%. So can you
Okay.
please zoom it at
Yeah.
120?
Let me just increase the font size. Better?
Yes, sir.
Then what is it in the fourth year?
4%.
4%.
Done?
Yes, sir.
This is in which currency?
Euros.
We need in which currency?
OER.
Dollars.
No, Yelan Rand. First we'll
Yelan
put
Rand.
in foreign country. See, understand, this is like Apple business, right? You're manufacturing it in China, but you're selling it somewhere else, right? So is the conversion rate for the first year given to you? Euro to Yelan Rand. Is the conversion rates available?
Yes, sir.
Where is it?
Current spot rate.
Under the current stock.
This is given. Which rate will you use? First year rate is how much? See,
1
spot
euro
will
is
be your
equal to
year
1.
zero. Spot will be your year zero. Okay.
Yes.
Now, so what are the rates? It is given 165. What is the next year? 180.2.
190.2. 100.
Correct, everyone?
Yes.
Everyone understood sales?
Mm.
Can you please solve it by yourself, the sales part?
So why do we multiply the fixed rate?
Sorry?
Why do we multiply?
Why do we multiply? You
Yeah.
tell me why should we multiply?
So can you go to the
Read the question and tell me why should we multiply? Anyone knows why should we multiply?
Because 1 euro is 165. So
Sorry?
it's euro per rand. So,
Correct.
so 1 euro is 142. So these many euros multiplied by 165. You get rand.
For 1 euro, you get 165 rands. So
okay, sir.
for these many number of sales revenue, how many rands will you get? Simple as that.
Okay.
Clear?
So usually the denominator will be considered as 1 unit.
Sorry?
The currency in the denominator is considered as 1 unit.
Currency in the denominator. There is no denominator over here.
Sir, no, sir. YR by euro.
Yes, sir.
Take the-
1 euro equal to 165 OR.
Correct.
That's what he asked.
Okay. Yeah, that's what it is. But be careful. Sometime examiner gives other way around also.
Okay, sir.
He might give you euro per YR also.
So why did we take euros and not the dollar?
Can you tell me why? I told you, right? What is our first step? I need to ensure what is the returns I am making in the foreign country first, right?
Yes, sir.
Right? When I'm manufacturing it in inland way, but my customer is in Europe, though I am a US company, my project is in which country?
Yelan
Inland way, right? So when my project is in inland way country, first I need to see what is my cash flow from the project.
Okay, sir.
Europe say direct US, I'm not going to get the money because Yelandway is selling the product to Europe. So first, the money will come to Yelandway and then I can take the profits out from there. Correct?
Yes, sir. Correct.
Because these are two separate entities, right?
Yes, sir.
Understood?
Yes.
In simple terms, first calculate the free cash flows in the foreign country. Simple. Remember that. Clear, everyone?
Yes, sir.
Any doubts still here? Any doubts, anyone?
No, sir.
Everyone done the sales. Anything on the variable cost? What is the question talking on the variable cost?
So
Again,
variable costs are same in L&B. It's 15,960 per component.
okay, so this is directly given to us
Yes, sir.
in Yelanwe, right? The currency is also Yelanwe.
Yes, sir.
Okay. So guys, for every line item of the cost or income or expense, you need to ensure that which currency is it so that you can convert it. What are the conversion rates for that? What are the oh, sorry, I don't need a conversion rate. What is the
We
cost of,
don't.
what is the variable cost?
So 15,960.
Where is it mentioned? Okay. 15,960. Then,
Sir,
but is
it
there
will
any
increase by.
inflation or anything that is mentioned for variable cost?
Yes, sir.
Yes, sir.
How much
For
is it?
both
22.
expected to increase by country's annual inflation every year from year one onwards.
They have specifically mentioned that it will increase from year one onwards itself, right?
Yes, sir. So
What is country's annual inflation?
22.
3%.
How much?
22%.
3%?
22%.
3%.
22%.
Yeah, landway is no, sir. On the first page.
Where is it mentioned, guys?
First page.
First page.
Okay, first year it is 22. Second year is how much?
14.7.
Third year is how much?
9.8.
Fourth year,
9.8.
same. Why am I showing it as a negative number?
Because it's cost.
It's a cost. Clear, everyone? Shriyaran, Devesh, everyone clear?
Yes, sir.
Okay. Have you finished calculating this variable cost? Yes,
Sir,
no,
sir,
yes.
sir, how do you show it as a negative? By simply adding the bracket.
Just multiply by -1.
Okay, sir.
So we have done with sales. We have done with variable cost. Let's go on to the fixed cost. Anything on the fixed cost?
Yes.
Sorry?
Given.
Naomi, can you be a little bit louder, please?
4,600. Correct.
4,000?
600 million.
4,600 million.
Hill and Verand.
Where is it mentioned?
Sir, just below the variable cost on the third page. First paragraph.
First para.
The current annual fixed sell law
Yes, sir. Same para.
The
Above.
variable cost.
after the variable cost. The current annual fixed cost.
Okay. And how much is it mentioned, the current annual fixed cost?
2,600.
So 4,600 a year rand.
4,000. Correct?
Yes, sir.
0.
I'll put a minus sign. But is the question talking on anything on inflation or any
Yes, sir.
increment, or what is it talking about?
Same as variable cost, what we have done.
How much?
Same as variable
Same.
cost for
Same
first
as
variable cost, sir.
variable cost. So that means I'll have to refer to this table. So first year it is how much?
4,600 into 1.33.
Sir, it's
Yeah.
4,600 million land varands.
Cannot be 4,600 million.
It could be for
It cannot be 4,600, guys. Your NPV will go negative. Just hold on.
So it's given in the question.
Let me open it. Don't
Take
worry.
it.
This is the IR. This is the NP. Foreign NPV. Railway company, IOMI company, assembly of the plants, the current selling price, sales component units, the
First
parts. Sorry?
First para, sixth line.
4,600 million. So,
4,600
no, we are working out in thousands.
thousand, sir. 4,000.
Can you see this, Naomi? We are working out in thousands, right?
Yeah.
So, what I will do is, then I put the numbers correctly. 4,000, 600,000. Got it?
Yes, sir.
If it was million, if I'm working out in millions, I would put additional 3 zeros. Okay. If I'm working out in thousand, that means I need to remove 3 zeros, right?
Yes, sir.
Understood, Naomi? Naomi, are you clear?
Yes, sir.
Second year inflation rate is how much?
14.7.
Third is?
9.8%.
Fourth is?
Same, sir. Same as last third year.
Is there any other cost?
Royalty.
Sorry?
Royalty.
No. Before royalty, any operational cost?
Okay.
Depreciation.
Sorry?
Depreciation.
Which one?
Depreciation.
Can you see something as a part cost? There's a part cost also, right?
Yes, sir.
Yes or no? Where is the part cost information given to you?
In line.
Okay. Which line?
Art needs to be assembled.
Okay. Now, they are importing a part from. Where are they importing the part from? Okay.
US.
First of all, part cost will be based on number of
Unit.
units. So let me put a number of units. What is the sales price?
200.
It's a cost, sir.
Hold on. Read this part component paragraph again and tell me how differently has this been framed? What do you think is the cost over here, and what do you think is the selling price, and what do you think is the revenue over here? Understand? You want to know what is the price at which Yelandway government is receiving that part.
280.
Are you sure?
No, sir, 240.
240, sir.
Sorry?
240.
Why 240?
They are making
So, because the cost in US is 200. For that Imoni company, they are selling by 40 for each component. So that's why the selling
They're
price
selling 40 or their contribution is 40. Do you know what do you mean by contribution?
yes, sir.
Sales minus variable cost.
Sales minus variable cost.
That is nothing but your gross margin. They are making $40. Okay. It feels that Yelandway company can negotiate and increase the transfer price to 280. Okay. Now, when their selling price was 200, their contribution was 40. How much was their cost?
160.
160 will be their cost? Yes or no, guys?
Yes, sir.
Now, if they change the selling price to 280, will their cost change?
Yes, sir.
No.
No.
Why will the cost change?
No, sir. It won't change. My bad.
Cost will not change, right?
Yes, sir.
But their contribution will increase. Correct?
Yes, sir.
Okay. Now, how much are they getting this for? What is the part cost for them? Second thing, part cost is mentioned to you in which currency?
Dollar.
Dollar.
Which currency?
Dollar.
Dollar.
Dollar. Okay. So tell me, what is the part cost? What is the sales price of the part? Because sales price of dollar will be equal to the cost price of Yelandway. Correct?
Yes, sir.
Yes.
Yes or no?
Yes, sir.
Yes. Yes.
Right? So, what is the sales price in dollars?
280.
280. Okay. Now let me put over here. Yeah, this is the part cost. Is there any inflation, guys, on the part cost?
No, sir.
Sure.
Yes, sir.
All the
No,
cost.
no, sir. Actually, we have because it has mentioned all these costs
Correct.
wherever incurred. So
Correct. So what percentage will we use?
USA 3%.
you
How much?
3%.
3%.
The first year it is 3%.
All the years.
Okay, it's flat. But we need the part cost in which currency right now?
Yelandway rand.
What is the conversion rates?
$1 is equal to 120.1 in the first year.
120.1. Then?
133.7.
Okay.
142.5.
Okay.
1.3.
How much?
151.3.
Did I get my part cost in the this thing?
Yes.
Okay. Because the selling price of US is the cost price of Yelandway. Correct? So we are done with this. We have arrived to pre-tax cash flow. Any other cost, management, royalty, anything is there?
Sir,
Yes.
can you go a little bit down?
Yeah.
Yes. Yes.
Guys, everyone solve the part cost. Everyone, 280 is the selling price. It's in US. US inflation rate is 3%. We calculate the part cost in dollars and then we are converting it to YR. Clear? Apparently, guys, this is one of the most complex for an NPV question that you can expect. Guys, everyone with me till here?
Yes, sir.
Naomi, Sashi, Hariyan, Divesh, Navjot,
Yes.
Sagar. Everyone with me till here?
Yes, sir.
Okay. Any other cost that is there for us?
Royalty.
Royalty?
Royalty expense.
What is the question talking on royalty?
First year 20 million currently. They are
How
paying,
much?
currently they are paying $20 million.
20 million every year?
No, they are going to negotiate and increase it by 80%.
Every year it is 20,000, right? But how much are they going to increase by?
80%.
Huh?
80%.
80% increase direct.
Yes.
Yeah, I have a doubt.
Yeah.
So in case of the podcast and royalty, they are just going to negotiate to increase the price, right? Then why should we take that price? Because
You
we
are
are
doing an
uncertain about.
you are doing an investment analysis, right?
Yes, sir.
Investment analysis, you will always take the scenario that you are expecting to happen. Correct?
Okay, okay, sir.
You are understand, you are not doing the past assumption or anything. No. You are trying to see if things work in my favor, is the project profitable? Understood?
Okay, sir.
Yeah. But royalty is given to us in which currency, guys?
Dollars.
So we need to convert it to. Is there an inflation on royalty?
No, sir.
It's a fixed every year.
Yes, sir.
So what I've done is current royalty of 2 million, 20 million, multiply by 80%. Understood? Because they're trying to increase the royalty by 80%. Clear, everyone?
Yes, sir.
Okay. Please finish the royalty part as well. Let me know once you are done.
Yes, sir.
Both of you done? Now, so we have calculated the free cash flows. Okay. Sorry, free operating cash flows. Then we have tax, right?
Yes, sir.
What is the question talking on tax? What is the question talking on depreciation? What is my total investment?
Total investment for land it's 21 million. Then for machinery 18,000.
18,000 million, right?
Yes, sir.
And for this is how much land?
20.
Okay. So what is your total investment?
18.
Okay. How much is the depreciation to be charged, they are telling?
SLM.
How much?
SLM basis.
Little louder, please, Naomi.
On SLM basis.
SLM basis, but what is the percentage? Or they want straight line?
25%.
25%? So what should I do? Can you tell me the numbers, please?
Sir,
Yeah.
like, if it's in percentage, then are we going to take it like on WTV?
No. When they say percentage and they say SLM, that means a fixed percentage every year on the principal. So in the 4 years, it will be 0. Understood?
So we're taking depreciation on machinery, but not on land.
Are you sure?
Yes, sir, because land is not depreciated.
Correct. Guys, in this question, there was a trick. The examiner has mentioned total investment, including machinery and land and building. Many people have gone wrong over there because that they take as a total investment. But you need to understand, as per income tax also, land and building never depreciates, correct?
Sir, building depreciates.
Right? But in this case, land and building will not be depreciated because it is assumed because you don't have a separate component of land and building. So it is assumed to be the not to be depreciated in this case. Okay. And
Sir,
technically
I have
also,
a doubt.
yeah.
Sir, in SBI, we used to depreciate building and not.
Hariharan, SBR is a different paper. This you're doing
Yeah,
an
I understand.
investment analysis. Okay.
Okay.
SBR is
So
a
in this,
rule-based paper.
okay, sir. So in this paper, we never depreciate land and building.
No, no.
Okay.
Because in this in SBR, when you are depreciating, you are given specific component. Key, okay, what is the portion of land value and what is the portion of building value? Correct?
Yes, sir.
SBR paper details out everything to do that adjustment. Over here, this is just a namesake number that is given just for you to know whether you should take it or not take it. Okay?
Okay, sir.
Right? Because over here, they are not testing our accounting standards. See, in real life also, when you do your investment appraisals goes on a different logic as compared to your accounting standards. Accounting standards are subject to manipulation. We are not applying accounting standards over here. Understood?
Yes, sir.
Okay. So 18,000 million into what percentage?
25.
25.
25.
Second year, third year. Depreciation is an income or expense?
Expense.
Okay. So 3 years depreciation would be how much?
For uh,
130,
18.5.
135,
4.5
right?
thousand.
Okay. So what is the WDV left?
4.5 million.
4.5 million.
Yes.
Is there a scrap value?
No.
And how much are you selling it for?
It's not given.
It's
Okay.
not given. Your asset value is 4.5 million, but you're getting zero money for that. So is it a profitable situation or a loss situation for you? Sorry?
Loss.
Right.
Loss.
Loss.
Loss. That means it's a balancing allowance or a balancing charge.
Balancing charge.
Balance.
Balancing
Allowance.
Charge.
allowance. That means you need to reduce your profit to that extent. Clear?
Uh, but
Yeah.
we would have used the machinery for the year 4, right? So depreciation should be included.
See, you do this, you remove it from here. That's what I'm trying to say. Last year depreciation, you do it or you don't do it. It is by default factored. It's just a presentational issue. Got it, Meet? If you depreciate in the fourth year, what you will do is you will take a sum of all the years and your value of machine will be zero and balancing allowance or charge will become zero. Correct?
Yes.
Right? Or you present it as a balancing allowance and charge and you do it because your balancing allowance and charge by default factors in the current year's depreciation also. Got it? In this case, we are not doing accounting treatment. What we are trying to see is, okay, my balance is for 45. I'm selling it for zero. It's a loss for me. But technically speaking, we are already covering that part. Understood now on the depreciation front?
Yes.
Sir,
Yeah.
sir, if there is a sale value given for the machinery, will we take it as a scrap value?
Yes. If it is given, if anything a sale value is given, you will take it as a scrap value.
Okay, sir. Sir, and balance allowance for charge will be calculated only if the question asks to. or
No, by
should we
default, it
calculate?
has to be calculated because end of the project, you're gonna sell all your machinery, right?
Okay, sir.
You are not gonna keep your assets when the project is over, right?
Yes, sir.
Okay. Now, first year, you're making a loss, correct? Is there any further information on the tax that is given to you?
No tax
No
into
tax.
first
No
year.
tax for first 2 years, correct? That means can I set off and anything on the losses it says
You can carry forward.
you can carry forward. Should I carry forward my year one loss to year two?
No
No, sir.
Why no?
Year
Because-
3 from year.
tax on second year.
Because the tax rate is zero. There is no benefit if I carry it to second year, right? I will save money if I carry it to third year. Got it? With me, guys?
Yes.
Yes, sir.
Okay. So I've carried forward the year one loss to year three. And then I've calculated this. I have the tax rate and I have the tax liability in foreign currency. Clear, everyone? I'll give you 2 minutes. Can you please go through the whole working and do it by yourself also?
Tax.
Yeah,
Sir, we cannot copy from the calculations and paste it in the pro forma, right?
you can do it. You can do it. You can do a pay special. That's fine. You can type out the numbers also.
So how to do the paste special?
Why do you want to do a pay special first? See, you just do this. Go to any of the column, right click. There's a pay special.
Okay, sir.
Guys, everyone finish the tax part. Everyone understood the tax part?
Yes, sir.
Okay. Let's go on to the working capital. What is the question talking on working capital, guys?
600 million.
How much?
600 million.
600
million rand.
Millions. So 600 into 1000.
Okay.
Inflation rate of Yelland.
Okay. Working capital inflates?
Mm.
Yes or no? What is the question talking on working capital, guys?
Yes, inflation of Yelland ways to be considered.
Inflation of your land is how much?
First year 22%.
Correct? Yes or no? Are we missing something in working capital? Can you read the working capital part again and see if you're missing something there? Which part has the working capital? Guys, where is the working capital mentioned?
On
First thing you need to be careful is you're looking out for incremental working capital. Correct?
Yes, sir.
Okay. What is the question talking? Where is it mentioned? It is 600 and all. Can you tell me
Sir,
which paragraph?
so starting from assembly plant in Come down, sir.
Over
One.
here?
No, sir, no, sir.
Second page.
Scroll. This first line. Assembly plant in LNV. First para.
First para decided to
No, sir, no, sir. This after Imani company, the assembly plant heading.
Okay. It is initially assumed that
Third line. The working
Third
capital
line.
will need to be increased annually at the start of each year.
it is 9,600 million, right?
9,000. Yes.
That's
Yes.
what I was saying. It cannot be this small. It is 9,600.
600.
Now it's correct. Okay. And every year it is increasing by
First year.
Based.
Pending our
no Yelandway companies
inflation rate.
inflation rate. Clear?
Yes, sir.
Clear, everyone? Okay. What is the initial investment? How much is my initial investment?
21,000, 18,000.
Plus.
Yeah.
Correct? But this is in which currency, guys?
Rands.
OIR.
So it is directly given in Yelandway rands.
Yes.
Okay. So we are done with the first part, that is calculating the free cash flows in foreign country. Clear?
Yes, sir.
Clear, everyone?
Yes.
Okay. I'll give you 2 minutes. Please go through this part and then I will move on to the next part of this step.
So the initial investment should be the machinery plus the land and building, right?
Correct. Because
So
that's the
it's
total investment, right?
39,000 million.
Sorry?
It's 39,000.
It's 39,000.
What is 39,000?
The initial investment.
Okay. Correct? I think I took it over here in zeros directly in millions. So it is 21 million plus 18,000 million. So it comes to 39. Correct? This is correct?
Yes, sir.
Yeah. Okay. Please go through this, the whole part. This is nothing but no rocket science. We are just ensuring that everything is in the same currency. Was it much complicated looking at the question? Right? There was so much information that if we don't have the pro forma, we would have been lost there. I'll give you 2 minutes. Please go through this and then we will go to the second part of the solution. Let me know once you guys are good to proceed to the next part. Because next part is pretty simple. There's not much of a rocket science there. Guys, everyone with me? Can I move on to the next part?
Yes, sir.
Okay. Once
sir.
I have finished everything in the foreign country, what do I need to do?
Convert.
Convert
Sorry?
into home currency.
I will bring that money to home currency. What is the conversion rate from Yelandway to dollars?
Current spot.
Yeah.
120.1.
120 point?
1.
Okay, where is it? 120.1. Where did you get that from?
It's first year.
That is for first year. But I have investment over here. What rate can I use?
Current.
which is, what do we call the current rate as?
What?
Spot rate. What is the spot rate?
101.4.
101.4. So guys, this I've actually worked it out in points only. It just got rounded off. Second year is 120.10. Third year is this. Fourth and fifth. Should I divide or should I multiply?
Rand.
Right.
Why?
Yeah.
Because
Rand to dollar.
grand to dollar, and dollar is a stronger currency. So you get less number of dollars when you convert rands. So this I've calculated my free cash flows. Royalty was an expense in Yelandway. What will it become in US?
Income.
It will become
Income.
income. So have I put it as an income?
Yes.
Right? If there is an income, have I paid any tax in this amount in US?
Land we know.
No. So that means I have to pay the tax in the home country when I come
Mm.
on this 3,600, which I'm treating as a management fees. Yes or no? Guys, yes or no?
Yes.
I have a doubt.
Yeah.
So the management fees and the royalty fees is not a tax deductible expense in the Ilan way. So why is it taxed in the home US?
Who said it is not tax deductible expense in Yelandway? How do you identify that?
So the first 2 years is, they don't pay tax.
That's not relevant. Your tax liability is calculated on your operating cash flows. Understand, this is US, now you are back to India. So now you'll have to do the treatments as per Indian government. Correct? See,
Yes,
Indian
sir.
government is, a lot of taxation benefits they are giving to bring foreign investment, to start companies and all, right? That does not mean that there is no tax rule in India. Correct?
Yes.
Right? That does not mean there is no tax rule in India. Understood? But it's just that government is giving out of courtesy. But your tax calculation, when you did a proper tax calculation and the tax rate was 0. Your free cash flows already included this as an expense. And you have carried forward your losses to the year. So you have already taken the benefit, right? Yes or no? Even if it is
Yes.
0%, you're taken the benefit of loss. You have paid 0 tax in foreign country because it's an expense. But in home country, you will have to pay tax because it's an income. Correct?
Yes, sir.
Right? So it will be taxed at 20%. Now, what is the tax rate in US and what is the tax rate in Yelandway?
20% in US, 40 in Yeland.
40 in Yelandway. Will I have to pay any top-up tax?
No.
No, because I already paid 40%. If I would have paid less than 20%, then I would have had to pay the differential. Correct? Yes or no?
Yes.
Yes, sir.
So we calculated our free cash flows. Loss contribution and redundancy, guys, I'll come to last. This is no rocket science. It just carries 1 mark. Even if you don't do it, it's fine. I'll explain you once you finish this whole question. Discount factor at 12% is how much?
Mm. For first year, it's 0.893.
Second year?
0.797.
97?
797.
Okay.
797, sir.
Okay.
712.
Okay.
0.636.
Got this, everyone?
Yes, sir.
Understood?
Yes, sir.
Any doubts on this? Now, let me tell you one more thing. Can you see in pro forma, I have considered tax liability in foreign and I said next taxable cash flow in home currency. Correct?
Mm.
If there would have been a difference, we would have calculated the differential tax. Okay? With me till here?
Yes, sir.
Okay. I'll give you 5 minutes. Please go through this. Too complicated, I understand. This was the last question for the day today. I'll give you 5 minutes more. Go through the whole question. Ask me any doubts that you have, please. And first, before doing that, please solve the second part. I think we have just discussed it. You guys have not yet solved it. First, solve it by yourself and then let me know if you have any doubts. Go through the whole and any working you have doubts, because there's a homework question for you guys. This classroom illustration 12, Hogwarts. It is not that complicated. This question is a foreign NPV question, which is for a homework for you. So please ask, go through this whole solution and let me know if you have any doubts, you want me to scroll anywhere, or if you have any queries.
So the note about the tax differential, could you explain that again? Why we didn't do it over here?
Which one?
The note about the tax differential rate. Yeah, this one.
Okay.
Why we not consider it?
Tax differential rate only is to be done if your home country's tax rate is higher. Okay.
Yes.
So the logic for the tax is whichever country's tax rate is higher, that tax becomes applicable to you, in short.
Yes.
Okay. Yelandway is higher, so you pay 40%, you are done. If Yelandway was 10%, then you would have paid balance 10% in US.
Yes. Okay.
It would be 20.
Yes.
So tax, the simple logic is jiska bhi zyada hai, whichever country has the maximum tax rate is to be paid. If foreign is paid, then we are sorted. There is no differential tax. But if it is less, then there becomes a differential tax. Okay?
Yes, sir. Yes, sir. Okay. Thank you.
Now, let me come to the last part, which is the loss contribution and redundancy. Okay. Can you see there's something mentioned on the loss contribution and redundancy over here? What does it say? If Naomi companies decide to invest, it exports from US to US to EU will fall and it will result in redundancy. Now, redundancy means it's a cost to you, right?
Yes, sir.
Because if your sales from US to Europe goes down, obviously your sales will go down. How much will it go down by?
20,000 in first year.
How much?
20,000 in
It is
first.
not 20,000. Understand this thing. These are already absolute numbers. Understood? So if I have to work it out in 1,000, it would be 20, 55.69 minus 55.69, then minus 57.36, then minus 59.08. Sorry, this has to be from year 1. Understood? This is nothing but your cash flow loss. Clear with me?
Yes, sir.
That's why I said this carries just 1 mark, because it has no impact on your overall calculation. See, you're at 2377. If you remove this, you come at 2518. Correct?
Yes, sir.
No material impact over here. Please go through this and let me know if you have any doubts. I wanted to go through the whole question. Let me know if you have any doubts.
So what about the contribution on part sales?
Sorry?
What about the contribution on part sales?
Oh, yeah. We missed that adjustment, right? What is it telling on contribution on part sales? See, US sold to Yelandway for 280. Yes or no?
Yes, sir.
Yes.
That means you have claimed the tax expense on that, right?
Yes, sir.
Yes.
Right? Now understand this. How much did you sell this for parts?
280.
280.
Along with inflation, this price. Okay. What is the cost of making this?
60.
What is the cost of making this, guys?
200.
160.
Look at this. When I was selling for 200, I used to make 40 rupees profit. That means my cost is how much? 160. When I sell it for 280, I'm making how much? So my contribution is how much?
120.
So variable cost is how much? 160. Should I be adding inflation, guys? Should I be adding inflation?
Yes.
Yes, no.
Yes.
This is your ideal situation. Okay. Now, how much should I inflate by? What is the US inflation?
3%.
All the years, is it 3%?
Yes, sir.
Okay. Now, cost has to be represented as negative. Clear, everyone? Now, did we pay any tax on this contribution, guys?
No.
No, sir.
No, right? Because we took whole 280 as an expense. Correct? We showed it as a cost of purchase in our books in Yelandway. Correct? Yes
Yes.
or no? That means I'll have to pay tax when I bring it to the home country.
Mm.
Can you see my top-up tax changing? Sorry, the tax changing over here because I haven't paid tax on this contribution, right, guys?
Mm.
Yes or no?
Yes, sir.
Okay. Understood now?
So can you please explain this part again?
Okay. I sold you part for 280. In your books, what is the cost?
280.
280. So while your tax calculation, you took a benefit of 280. You reducing your profit by 280. Correct?
Yes.
Now, we both are friends. That means we are one company only, but operating there in a different branch. Correct? Now, I'm selling it for 280. But what is my cost?
160.
160. 280 minus 160 is how much?
120.
That means every part I am selling to you, I am making profit of 120. Correct?
Yes.
And on that profit, you did not pay any tax in that Yelandway company. Correct? Because you took full 280 as a cost.
Correct.
That means the profit on 120, I have to pay tax,
Yes.
right? So that's what I've done. I've calculated the profit at 120. Look at this. 120 is the profit, net contribution including inflation. Understood?
Yes, sir.
Clear, everyone? Anyone has any doubts, any questions?
So when will you upload this Excel sheet? By the evening, possible?
Yeah, by evening I will have it done.
Okay, sir. Thank you.
Any questions on this, guys?
Hmm.
Yes, no, confused, lost.
No, sir.
Okay.
Okay.
Guys, illustration 12, please try it by yourself. One thing. Second, I want you to redo this whole question by yourself again. Okay.
Okay,
Okay.
sir.
This is one of the most complex question of foreign NPV, but it is not that confusing and all. Have your pro forma, go step by step. Just look at fill in the blanks. Like probably I missed at looking at contribution cells because I was confused. I was going on to tax, royalty, and all of those things. But if you have something in front of you, you know you're missing something, right? Yes, someone has raised their hand.
Yes, I just had one doubt. The inflation of 3% will be on the previous year, right? You took 124 for all the 4 years.
Oh yeah. Wait, I'll have to put in the inflation over here then. Yeah. Good with me.
Yes, sir. Got it.
Yep. Okay, guys, any other questions? Any other questions, guys? Yes,
No,
no.
no, sir.
Okay. With this, guys, we are done for the day. I will not start with another question because that's an AP and that is little more complex. So few topics which are critical, we will cover specific in detail as and when we are doing the fresh concepts and all. Okay, guys. And I will have this shared on the WhatsApp group. And guys, anyone who has not received their notes, please make sure you get the notes before the next class.
So
If
I'm not a part of the WhatsApp group.
can you ask your student coordinator or whoever you're coordinating in Zell with, because I am not the admin, so I won't
Okay,
be
sir.
able to add you. So can you
Okay.
just tell them to add you to the WhatsApp group, please?
Yes, sir. Yes, sir.
Yeah.
So I can share the link over here.
Okay, thank you.
Thank you,
Thank
sir.
you, sir.
Thank you.